Today, we're going to talk about something that confuses almost every single homeowner I ever meet, and that is going to be PMI or private mortgage insurance. So if you bought a house with less than 20% down, there's a chance you're paying PMI every single month, and you might not even realize how much it's actually costing you. So in today's video, I am going to be breaking down what PMI really is and why you're paying it. I'm going to explain to you how to get rid of it and how doing that can literally save you thousands and thousands of dollars over the entire life of your loan. And if you stick around to the end of this video, I will also explain how timing your refinance or equity review the right way can help you to ditch that PMI much faster, especially in Long Island, New York, where home values have jumped big over the past few years. So let's get into it. First off, what exactly is PMI really? PMI stands for Private Mortgage Insurance. It is a fee that you pay to protect the lender, not you, in case you stop making your payments on your loan, okay? So very clear distinction there. PMI exists to protect the lender, not you. So it does not benefit you directly. It's simply the price of getting into a home with less than 20% down. So if you bought a home for $600,000 in Nassau County, New York, for example, and you put down 10%, you borrowed $540,000. Because that's above 80% of the home's value, the lender adds PMI to your monthly payment until you've built enough equity. So think of PMI as a bridge. It helps you get into the home sooner, but the goal is to cross it and to move on. So how much does PMI cost? That is the question of the day that a lot of people ask. And it really depends on a few things. Mainly, it's going to be your loan type, your credit score, and down payment amounts. So for most conventional loans, PMI usually runs between 0.5% and 1% of the loan amount per year. So if you have that same $540,000 loan, you could be paying anywhere from $225 to $450 a month just in PMI alone. Over time, that's $2,700 to $5,400 per year, money that's not building equity or paying down principal at all. Now multiply that over several years and you're talking tens and thousands of dollars. So this is no small deal at all. Here's the kicker. A lot of homeowners end up paying PMI for years longer than they have to because they don't realize that they can remove it. They don't know that this is even an option. So that leads to, when can you get rid of PMI? And here's how it works. By law, lenders are required to automatically cancel PMI once you hit 22% equity, meaning when your loan balance drops to 78% of the home's original value. But you don't have to wait that long. You can request PMI removal as soon as you hit 20% equity, either by paying down your loan or because your home's value has gone up. So, for example, let's say that you bought a home in Plainview, New York in 2021 for $650K. Since then, prices have climbed, and today that same home might be worth around $725K. That means you may already have 20% equity just from appreciation alone, even if you only put 5 or 10% down originally. All you have to do is contact your lender, request a new appraisal, and show that your equity has hit that threshold. Once that's verified, the PMI can be removed and your payment will drop immediately. So that could mean saving $300, $400 or more every single month. So I'm gonna give you right now the step-by-step how to remove PMI early. So here's the process, and I'm going to try to keep it as simple as possible in plain English. Check your current balance and home value. Look at your most recent mortgage statement for your payoff amount. Then I want you to compare it to your home's current market value. Okay? Not what you paid, but what it's worth now. You can get a CMA. Okay, that's a comparative market analysis. You can get your real estate agent to do this for you, and they can estimate this for you. So calculate your loan to value ratio. So you're going to divide your loan balance by your home's estimated value. If it's 80% or lower, you're in the range to remove PMI. Okay, you can also request PMI cancellation, contact your lender in writing, and ask what documentation they will need. Okay, most lenders typically will require a professional appraisal to confirm the value. So get the appraisal done. I always recommend this. It usually costs a few $100s, but if it proves your home has enough equity, you'll save way more in the long run. So once the lender approves it, your PMI drops off permanently. It's going to be gone forever, and that's what we all want. So now let's talk about how appreciation is something that can speed this whole process up. If you bought a home on Long Island anytime between 2019 and 2022, you've probably seen your value rise very, very significantly, and you've probably got yourself a great rate right now. Homes in Seaford, New York, Levittown, and Wantagh, for example, are up around 25 to 30% since the pre-pandemic levels. In Suffolk County, New York, areas like Patchogue, Smithtown, and Bayshore have seen double-digit appreciation as well. So what that means is that a lot of homeowners are sitting on way more equity than they realize right now. And that's just simply attributed to the power of real estate. So if you've owned your home for 2 or 3 years, you might already qualify to remove PMI right now without waiting another 5 to 10 years for your balance to drop naturally. Even if you're not sure, it's something that is definitely worth checking, because for many of my clients, a simple appraisal showing that value increase has been the key to knocking off their $300 plus off their monthly mortgage. But what if you can't remove it yet? Then what does that mean for you? That's where refinancing comes in. Okay, and if your current rate is higher than today's rates, you can refinance your loan to both drop the PMI and to also lock in a better rate. So let's think of an example here. A client in Massapequa Park buys a home in 2021 with 5% down at around 4.25. By 2024, the value goes up nearly $100,000 and their loan balance drops below 80%. They refinance into a new conventional loan. They eliminate PMI entirely and end up eliminating $420 off their monthly payment. Over time, that's merely $5,000 a year saved just by knowing the rules and timing it right. Now, one quick note is that not all PMI is created equal. If you have an FHA loan, your mortgage insurance works completely differently. And in that case, it's called a MIP, which stands for Mortgage Insurance Premium. And it doesn't automatically drop off like conventional PMI does. To remove FHA MIP, you usually have to refinance into a conventional loan once you've built enough equity. It's an extra step, but the math still makes sense in many cases, especially once you've got that 20% cushion. So next, let's talk about why this matters. Okay, PMI might not sound like a big deal, but every dollar counts when you own a home, especially in this economy that we live in the United States. So let's say your PMI is $350 a month. That's $4,200 a year. Over 5 years, that's $21,000. That's money that could be going off towards paying your loan faster, remodeling, or investing elsewhere, or just spending on vacations and doing fun things, other things in life outside of real estate. And removing PMI is not complicated. It's just something that most homeowners don't know that they can do early. And so that is why I always tell my clients every 6 to 12 months that you should do a check, do a review of your equity, because markets shift, values change, and you might be significantly closer than you think to dropping that payment off for good. Okay, especially with how home values have been increasing over the last few years. So the bottom line is, if you're paying PMI, you're not stuck with it forever. The key is knowing when your equity hits that 20% mark, and then being proactive about asking your lender to remove it. So check your current value, run your numbers, and take control of that payment. That way you can open up your finances and have more enjoyment out of your life for the things that you want to do. It's one of the easiest ways to save thousands without moving or changing your lifestyle at all. Okay? And if you're not sure where to start, talk to your real estate agent or your lender about running a quick equity review. 5 minutes of effort is something that could save you hundreds every single month, which could translate into thousands per year and over the years. And if you're ready to take that next step and you want to buy a home and want to work with me directly here in the state of New York, check out the description down below to set up your free consultation with me. We will go over your goals, your budget, and we will map out a game plan to help you to move with confidence when it comes to buying the home of your dreams. So if you found this video helpful today, don't stop here. Click the video right here on your screen to join my free webinar right now called From Hesitant to Homeowner: How Smart Buyers Win in Any Market. Click that next video right here, right now, and I look forward to seeing you all in the webinar. Take care.